Hello, Market Rebels! Well, last week we found out why traders are often taking more risk than it may appear by measuring with the wrong ruler. This week, a related topic. If you're hedging positions or using safe strategies, you're not reducing risk, only changing where it appears. Risk never goes away, it migrates. Check the closet. You know the feeling. You were certain that guests were coming later, absolutely certain. And you were right. It's just that later turned out to be much sooner than expected. You didn't exactly forget, you just remembered incorrectly. So you scramble to clean the house, coffee table is cleared, desks are organized, the kitchen counter suddenly has space you forgot it had. Everything is perfect, except the closet door won't close. Nothing was thrown away. Nothing was destroyed. The mess didn't vanish. It was relocated. What changed wasn't the amount of disorder in the house, only where it lives and whether guests can see it. This is how many problems are solved, not by reducing them, but by moving them somewhere less visible, less uncomfortable. The relief feels real because the evidence is gone, out of sight, out of mind. The illusion is convincing until the closet is opened. Risk never leaves, it migrates. Traders often talk about reducing, hedging, or even eliminating risk. It sounds like they're being careful, but this language is deeply misleading. Risk lives in the market, and it's not something that can be destroyed. It can only be moved. It migrates. Your positions just move it to different locations, different closets. Your account only records which risks you've agreed to carry and which you've pushed onto someone else. You can't push risk out of the market. You can only decide whether you hold it or pay someone else to hold it for you. Understanding risk migration is one of the most important conceptual breakthroughs a trader can have. It explains why safe strategies periodically implode, why income strategies feel easy until they fail, why tail events arrive faster than intuition allows, and why option premiums behave the way they do. Once you see risk as something that can only be conserved, many long-standing trading paradoxes disappear and new insights appear. No trade removes uncertainty about the future price path of an asset. The future remains uncertain regardless of how cleverly positions are structured. When traders hedge, roll, cap, or define risk, what they're actually doing is changing where risk lives, when it's realized, how it appears, and who ultimately bears it. Risk is not in the instrument, it's in the future. Options, stocks, and strategies are merely containers that redistribute exposure to that future. Options are a market for risk. In everyday life, we pay premiums for safety. We buy insurance, live in safer neighborhoods, and accept lower returns in exchange for reduced uncertainty. Options are different. They're not insurance markets in the traditional sense. They're risk-clearing markets. Every option trade transfers risk from one participant to another. When traders pay a premium, they're not paying the market to eliminate risk. They're compensating another participant to hold it. When traders collect premiums, they're not being rewarded for safety. They're not generating income. They're being paid to accept risks that others don't want to hold. Once you understand that risk can't be destroyed, only shuffled around, you'll gain a deeper understanding of strategies, hedges, and even rolling. Stop orders are potential cliffs. Let's start with stop orders, as many traders think they're free put options. They think using stops will reduce risk. But here's the problem. Everyone else thinks that too. If the stock is $100, traders usually choose round numbers, so may place stops at $95. The problem is that if the stock trades at $95, a ton of market orders hits, and the stock can gap right through it. You were expecting to get filled at $95, but get filled at $90. So what you thought was a risk-reducing strategy was risk migration. You chose to accept a conditional market risk. If the stock trades at 95, I'm willing to take a much bigger risk. You didn't eliminate risk, you just chose a different risk to accept. Rolling options is just another closet. Rolling calls up, or puts down, is usually described as locking in gains or reducing risk. But rolling does not remove uncertainty. It reassigns it. You may have rolled the position, but you've rolled the risk to a different closet. If you roll a call up for a credit, it appears that risk has been reduced. The credit sweeps money off the table, and the new call still allows you to capture additional gains. But now that you understand that risk migrates, where did it go? The credit received isn't payment for safety. It's not income. It's a payment for accepting risk. When you roll a call, you're simply selling a vertical spread, which of course generates a credit. So the risk comes from selling vertical spreads. The market never pays to reduce risk. The credit is compensation for accepting a lower probability of success and greater dependence on favorable market environments. Rolling a call up means you've exchanged price risk for timing risk, and delta exposure for probability exposure. That doesn't mean rolling is bad. Instead, you must understand what you've exchanged. You must understand where the risk went. Let's say the stock is $110 and you're holding the $100 call worth $12. There's $10 of intrinsic value plus $2 of extrinsic value. You see this $12 value as a big risk, so you look at the quotes and find the $110 call trading for $7. So you roll to the 110 call for a $5 credit. In other words, you sell your $100 call for $12 and buy the 110 call for $7. That's the short vertical spread. That's where the credit comes from. Mathematically, you're long the $100 call and short the 100-110 vertical spread. You've increased the risk. You reduce the downside risk by $5, but increase the expiration break-even point from $112 to $117. That's a deferred risk, as any stock price at 117 or below creates a loss. You've converted a trend trade into a timing trade. Before the roll, direction mattered more than timing. After the roll, timing matters more than direction. Now you need the stock to make a more aggressive move in a shorter time. You've also eliminated the $10 of intrinsic value that was immune to volatility and time decay. Your new 110 call has no intrinsic value and 100% extrinsic value. You've traded certainty for optionality. Again, this doesn't mean that rolling is bad. It's only bad if you focus on the credit and say you generated income or reduced risk. Instead, train yourself to say the risk migrated. If you can't summarize where this risk is, which closet you moved it to, you need more options education, not more rolling. Selling far out of the money puts isn't printing money. Selling far out of the money puts is often described as conservative income generation. In reality, it's the acceptance of catastrophic exposure. Sure, it may look like a super low probability event, but that's under current conditions. The premium exists only because when the losses occur, they'll happen during big shifts in market conditions. If volatility spikes, correlations rise, liquidity disappears, forced selling accelerates, and that low probability suddenly shifts to 100%. Language also reveals understanding. Professionals speak of probability, convexity, and tail risk. Amateurs speak of credits, safety, and income. When traders describe a strategy as printing money, they're usually describing a period in which risk hasn't yet repriced. Smooth equity curves, high win rates, and steady income are symptoms of deferred risk, not eliminated risk. The bill arrives during risk transitions, not during calm periods. if it happens. The problem is that you're acting as a reinsurance agency without the balance sheet. Traders often defend their actions by saying, if conditions get worse, I'll exit. But that's like saying, if the bridge collapses, I'll get off. No, you won't. The collapsing bridge isn't a warning, it's the condition you're trying to avoid. More importantly, a far out of the money put doesn't need to go in the money for disaster to occur. It can go up tenfold or far more if volatility spikes and the stock falls a modest amount, say 10%. And it doesn't matter if you're confident that it'll bounce back. If you have a large margin call, your broker probably closed the position on the opening bell at the absolute low, the worst possible time for you. Sure, when you sold the put, it may have been a low probability for going in the money, but that was under those conditions. If conditions change, probabilities do too. That apparent low probability just migrated to a different set of circumstances. Covered calls and risk concentration. Covered calls are often marketed as income strategies that reduce risk. In reality, they migrate risk by giving up the favorable upside gains in the stock to concentrating it into downside and volatility exposure. When you sell a call, you chop off most of the upside gains, but still hold most of the downside risk. Sensitivity to unfavorable market conditions increases. Sure, the premium smooths small price drops, but does little to protect against large ones. It's not that covered calls are bad. They're bad when traders think that selling far out of the money calls is a way to collect easy money. Those out of the money calls bring in very little money, but always leave you exposed to 100% of the downside risk. The strategy works best in calm, range-bound conditions and fails precisely when protection is most needed. That's risk migration. Risk migration means risk is stored. Periods of calm don't drain risk. Instead, they let pressure build behind the dam. Low volatility isn't the absence of risk. It's risk waiting to be realized. Why? Calm markets invite leverage, concentration, and confidence, the very mechanisms that store risk for the future. Quiet markets don't make strategies safer. They make positions larger. If the stock is $100, traders may feel comfortable selling one $95 put. But if markets appear calm and safe, those same traders may now sell 10 of the $90 puts. The apparently calm market migrated risk to a different catastrophic level. This is one of the key reasons why volatility tends to appear in bursts. When the dam breaks, the flood takes all positions with it. So before you think those far out of the money puts absolutely can't go in the money, you're measuring risk before the dam has broken. Risk is not a feature of trades, it's a feature of the future. Markets merely decide who holds which slice of it. Once you understand that risk is conserved, trading stops being about eliminating danger and becomes about choosing which risks to hold. Markets don't reward safety. They reward the willingness to absorb uncertainty where others will not. Options don't make markets safer, they simply make risk tradable. So take a professional approach to trading. Don't just look at the risks you're avoiding. Instead, ask which risks you're holding. If you don't see them, they're there. They've just been moved from the counters, cleared from the tables, swept from the floors, and moved to different closets. Next week, we'll continue this same theme from a different angle, the Peltzman effect. Find out why seatbelts increase accidents and why your risk-reducing strategies may just be the riskiest of all.